Hello, and welcome to this financial analysis lesson, which will focus on the relevant costs for decision-making. After you have finished this lesson, you will be able to, firstly, identify the costs that are relevant for strategic decision-making. Secondly, apply the relevant cost principle to material, labour, and assets. And thirdly, understand how to apply the principles to strategic decisions. To begin with, let's look at what is meant by short-term decision-making. Short-term generally refers to decisions with an impact of less than 1 year, and you generally only consider variable costs and ignore fixed costs. Business decisions with a long-term impact of more than 1 year would generally need to cover fixed costs. Short-term decisions focus on answering questions such as whether to accept or reject a tender price, whether to undertake a project internally or outsource it, or whether to cease producing a poorly performing product. When answering these questions, only the relevant costs or benefits should be considered when making the decision. This is to eliminate any unnecessary data that could complicate the decision-making process. Relevant costs are costs that have not yet been paid, costs that change because of a decision, and costs that can make an incremental change to future cash flows. It is important to remember that relevant costs are just the starting point for decision-making. It is often necessary to consider non-quantifiable factors before a final decision is made, such as the impact on market share or a desire to break into a new market. There are two particular types of relevant costs in decision-making: opportunity costs and avoidable costs. When deciding, it often means you cannot use a resource in other ways. As a result, there may be an incremental loss of future cash flows, and thus relevant costs. For example, the extra profit you could have made by using a resource on a different product. This is called the opportunity cost, which is the benefit lost by not pursuing the next best alternative. By contrast, avoidable costs refer to those costs that will no longer be incurred if a particular decision was taken. For example, if a product line is discontinued, some staff may be made redundant, so their salaries would be avoidable costs. There are some costs that are not relevant for short-term decision-making. If costs have already been paid for, they are known as sunk costs and will not change because of a decision. Therefore, they should not be considered. Similarly, any committed costs will not be relevant, as they will be incurred whatever decision is made, even if they have not yet been paid. Notional accounting costs, such as depreciation that do not have a cash flow impact, should be excluded. And allocated costs that may be allocated to a project should not be considered, as long as there is no change in the actual costs incurred. Let's look at some examples from the airline industry. If an airline had already bought some materials and did not need them to be replaced, the cost of purchase would be sunk and would therefore not be relevant to any future decision. And for each scheduled flight, the crew and pilot costs have been committed and would still need to be paid even if no passengers turned up to fly on the day. The depreciation charge on aeroplanes would be a notional accounting charge, not an actual cash flow, so should be ignored for future decisions. And when it comes to allocated costs and calculating the accounting profit made per flight, there may be a charge for the associated admin costs, such as staff time processing bookings, which could be calculated on a per-passenger basis. However, unless there are incremental costs involved, these costs would be incurred anyway, so are not relevant to any future decision. Take a moment to consider the differences between accounting costs and relevant costs. Accounting costs are historical, and will include all costs that relate to revenue and will account for depreciation. By contrast, relevant costs are future-looking and only focus on costs that change cash flows because of a decision. Any historical costs already incurred are excluded. This means that a new project could show an accounting loss, but still be beneficial for an organization if only the relevant costs are considered. Now let's see how the relevant costing principle can be applied to materials, the labor force, and assets. For materials, the two main considerations are whether the materials needed for a project are already in inventory, and if they are, will they need to be replaced? If not, there may be no relevant costs. For labor, if there is spare capacity, then there may be no relevant costs of using them to work on a particular project. And for assets, if you are already using an asset elsewhere in the organization, then there may be no relevant costs of diverting it to work on a new project. Let's look at these cost principles in more detail. Here is a decision tree looking at the relevant costs for materials. The questions you need to be asking focus on whether the materials are in stock, are used regularly, and have a resale value. Answers to each question influences whether there are relevant costs to be included in any short-term decision-making. Let's look at a worked example. Take time to review the case example on whether to accept a tender to manufacture a bespoke machine, and the question to be answered. The answer follows on the next slide. As you can see from the slide, there are relevant costs for both material X and Y. 3,000 kilograms of material X is out of stock and needs to be bought at current market prices, whereas the 2,000 kilograms in stock also needs to be replaced, as it is regularly used within the business. Although material Y is in stock and not regularly used in the organization, it still has a resale value, or opportunity cost, which is the benefit lost by not reselling it. For top gear, it means the relevant cost of materials for the tender would be $24,250. Here is a decision tree looking at the relevant costs for the labor force. The questions you need to be asking focus on whether the existing labor force has any spare capacity and whether further labor force hours be obtained. Answers to each question influences whether there are relevant costs to be included in any short-term decision-making. Let's look at a worked example. Take time to review the case example on whether to accept a tender to manufacture a bespoke machine, and the question to be answered. The supervisor is currently employed on salary, meaning no future incremental costs. However, for the skilled labor force, the relevant costs are shown on the next slide. As you can see from the slide, the existing labor force has 20 hours of spare capacity, leading to 0 relevant costs. However, 30 hours of labor force still needs to be obtained via the cheapest alternative of hiring temporary workers, rather than paying the more expensive overtime option. For top gear, it means the relevant cost of labor for the tender would be $840. Now, if top gear also required 12 hours of a senior engineer to work on the tender, who would need to be diverted from their time working on product B, how would this affect the relevant costs? The answer follows on the next slide. As you can see from the slide, with the engineer's time diverted, the relevant costs relate to the opportunity costs of not making 12 units of product B. The engineer's costs will still be incurred, despite his time being diverted, so will not be relevant to the decision. This means the relevant costs relate to the lost revenue minus any materials saved from being used. In this example, this equates to $270 per unit of product B, totaling $3,240 as the opportunity cost for not making 12 units. To conclude this section on how the relevant costing principle can be applied, here is a decision tree looking at the relevant costs for diverting assets, such as machinery. The steps you need to be taking are, firstly, to work out the recoverable amount, which is the opportunity cost of not using the asset somewhere else in the organization, or if higher, the resale value of the asset. Secondly, you need to work out the deprival value, which is the amount the organization would be deprived of if the asset were used in the new project. This would either be the loss of the value it brings elsewhere in the organization, or, if lower, the cost of replacing it. Let's look at a worked example. The tender currently being assessed by Top Gear requires the use of a piece of specialist machinery for the duration of 1 year. Using the data on the slide, what would be the relevant costs of the machine? The answer follows on the next slide. As you can see from the slide, the value of the asset in use is higher than the resale value, so the maximum amount Top Gear could utilize the asset for is $12,000. With a replacement cost of $13,000, the recoverable amount is lower than the replacement cost, so the deprival value is $12,000, and this should be included in the tender costing. Now let's put together what you have learnt so far. You can apply relevant cost theory to short-term decisions that focus on answering questions such as whether to accept or reject a tender price, whether to undertake a project internally or outsource it, or whether to cease producing a poorly performing product. Let's look at these decisions in more detail. As you have progressed through this lesson, you have been working on behalf of Top Gear, working out the individual relevant costs for materials, labour, and assets in relation to a tender for the manufacture of a bespoke machine. The relevant costs have been calculated as $40,330, as summarised in the slide, and this should be the minimum price that Top Gear should charge for the order. Top Gear could add a profit margin on top, but there may be sound strategic reasons for submitting a minimum price, such as to win new business or to build market share. Turning our attention to a make or buy decision, take some time to read the slide example for a bicycle manufacturer considering ceasing the production of its own wheels and instead buying them from outside. By identifying the relevant costs of making one wheel on a purely financial basis, Tread would be better off buying in the wheels at $9 per wheel than making them at $10 per wheel. However, Tread should also consider other factors in its decision-making, such as the loss of control by outsourcing, the loss of expertise from within the organization, and the potentially negative impact on staff morale. And finally, let's consider a decision whether to discontinue a product line or not. Take some time to read the slide example for a manufacturer of hair products considering whether to discontinue the production of the conditioner product or not. Despite a positive contribution margin of $67,000, a key consideration is the conditioner's product's contribution towards fixed costs. If the product was discontinued and there are more than $67,000 of avoidable fixed costs, then total profits would improve. But if avoidable fixed costs are less than $67,000, then DG should keep producing the conditioner. In summary, when analysing the relevant costs for decision-making, Understand what relevant costs are, such as opportunity and avoidable costs, and the types of costs that should be ignored, such as sunk costs. Take time to understand the relevant costs for specific cost types, like materials, labour, and assets. Relevant costs can be applied to various short-term decisions, such as whether to accept a tender or not, whether to make or outsource an item, and whether to discontinue a product line or not. To make your analysis more meaningful, take the whole business view, which means relevant costs are only the starting point for making decisions. It will also be necessary to consider non-quantifiable factors, such as the impact on staff morale, and potentially fixed costs, which will need to be covered in the long term to make a profit. Thank you for participating, and see you next time on another exciting business training lesson from Pontema.